Hey guys, Mike here. So today I want to talk to you about, Ark Invest and Cathie Wood, who just released a 45-minute video talking about what they're going through, what she's seeing on all fronts, what's causing this big drop. And, she gave some really good insights. And so I try to do, you guys always like to, I try to compress these, long 45-minute videos down to like 10 minutes. So I tried my best with this right here. And I also provided visuals and stuff. And it's not just her talking, you can actually visualize what she's actually talking about. And so I hope you like it. But anytime you can listen to, any kind of fun, talk about all the research and what's really happening. Because if you're holding high growth stocks, especially her high growth stocks, you'll definitely want to listen to this. And I'll kind of jump in and out sometimes because some of the things she says, make sense, but some of them are kind of alarming in a way. So I want to get your opinion on that as well, okay? So if you get anything out of it, hit the like and subscribe button for me, guys. And let's go ahead and get into Cathie Wood and what she has to say.
I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and Ark funds, which are more than half of my IRA. We're all in, and my conviction couldn't be higher. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there, because, of course, genomics was a big part of the solution to a problem we were facing. And since February, as this rotation into value from growth really accelerated, these same algorithms have had good success with this strategy. They've been focused on inflation fears, interest rates, and valuations. And they have likened what we're going through right now to the tech and telecom bubble and the bust. And so the algorithms as well are basically looking at momentum and saying, once the bubble pops, that's what they're calling this, it doesn't stop. It's 80, 90%. We think that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation.
And I'm curious to get your input on what she just said about 80 to 90% dropping. Once these algorithms and the momentum trading starts to happen and starts pushing those stocks down, they won't stop before they're down 80 to 90%, like they were in the .com bubble. And you've seen some of the stocks she's talking about are down between 50 and 70% already. So do you think she's trying to put a warning out there saying, there's a lot more downside here, at least another 10 to 20%. I'm curious about that because I understand her ETFs, for example, there's actually another ETF that was created just to short the stocks she owns, and it's doing very well, by the way. And you know how hedge funds are. They've been shorting the heck out of her names and out of these stocks. That's why they've been pushing down so fast, so hard, and not recovering. And we all have owned stocks where we've seen, once these institutions start shorting these stocks, just, you can look up GameStop, AMC, all these other ones, all the short videos I put out showing you what these guys are doing. Once they get on board and start pressing down, they will drive them down into the ground and then kick them a few more times to get them under the ground. So curious to get your input on that. So now let's go back into some insights she has on the economic factors, market factors, things like that are affecting the market as a whole and her stocks.
What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory.
And this one all comes down to what you believe is temporary. In the comments, tell me, how long is temporary to you? Is it 3 months, 6 months, 9 months, a year, 3 years? Like, what is temporary to you? And that's what this comes down to. For me personally, temporary, I'll say 3 to 6 months, and we're past that. Even the Fed has retired that because they realize this is not temporary, okay? And you're going to see something she's going to talk about in just a minute that shows this is not temporary, okay? But again, it depends on what your idea of transitory / temporary, same meaning, actually is, okay?
Now, on fiscal policy, that one's easy. Senator Manchin from West Virginia is basically saying he's not going to negotiate. I think he too has been citing inflation, debt, and taxes as 3 reasons not to spend more money. So we think the good news there is that some of the onerous tax increases that were part of that package will not go through. And so that's good news. That's good news. Now, on to economic statistics. And here again, this is the sort of analysis that we were doing at the beginning of the coronavirus, pulling out of these reports data that you are not hearing on CNBC, Bloomberg, newspapers. They're just not making the headlines. Before I do that, we'll go through employment, since this is Employment Friday. And today's employment report had something for the bulls and the bears. Headline non-farm payrolls, much lower than expected, 199,000, expectations 420,000. There was a slight increase, but not enough to make up for that difference, an increase in terms of revisions. The unemployment rate dropped below 4%. So now we're getting back to the levels where we were in the early stages of the coronavirus. And one of the reasons is the labor force is growing much more slowly. It went up only 168,000 in this last month. So the unemployment rate keeps coming down. Interestingly, as we look through the report, it is the lower end of the wage range that is seeing some dramatic increases. And we're hearing about them anecdotally as restaurants and fast food restaurants are bidding up to bring new workers in. Now, so that's employment. So some for the bears, some for the bulls. I would say more for the bears from an interest rate point of view and on the average hourly earnings. I'm sure the Fed took a close look at that.
And that's where, I don't know about you, but a lot of people lose me on the transitory argument when it comes to inflation, which is just a definition of higher costs, right? That's what inflation is when it comes to the labor issue, right? I mean, if a position was $10 before the pandemic, right? Now all of a sudden we're paying $15 to $20 for that same position, you know, what are they going to do? All of a sudden, 6 months to a year from now, just fire everybody that they hired at the new rate, lower it back down to the original rate, and then rehire everybody? Of course not, right? That is here to stay. So those expenses are going to be up, right? And usually the big expense a company has? Usually labor and benefits, okay? And so they're going to pass all that on to us. That's not going to stop. It's not going to go anywhere. We can fix the supply chain issues. Hopefully, eventually, I've heard they're getting better. I've read about that. But with the labor, I mean, somebody please, I'm not an economist, so put it down in the comments. Explain to me how we're going to get back to, you know, decreased wages or where they were pre-pandemic. You know, let me know what the plan is, because I don't know. So that's where she loses me on transitory when it comes to that part right there. And so that, and obviously the Fed, you're still taking a very big look at that because they don't know.
Now on to market signals. The yield curve peaked at 130 it was February or March of last year. I think it was March, and has been falling. Now the yield curve is the difference between short and long-term interest rates. Normally long-term interest rates are higher than short-term interest rates. They were, as measured by the Treasury curve, so government bonds and notes, the yield curve, the longer term bonds were 130 basis points, 1.3% higher than the 2-year yields in March of last year. At the end of last year, that number was 80 basis points, 0.8%. Today, it's 0.6%, even though bond yields are up, short yields are up more in response to the employment report, and that 0.6% on average hourly earnings. The yield curve narrowing generally is not a good thing for financial stocks, but this rotation into value stocks, energy is up 5% this year, energy's up 10%, financials up 5%, and they were two of the strongest sectors last year. Seems to be on automatic pilot. This yield curve would suggest that financials should start to underperform. So we shall see. The rotation is still towards value. It is hurting growth. We think it's long in the tooth. We think it's going to end, but it hasn't ended yet. And the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars. The dollar's going up. All other things equal, commodity prices would go down. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived.
And so I hope she's right, and this is short-lived. I'd like to know what her definition of short-lived actually is. So let me know in the comments. Do you think there's more downside to be had here, and especially her kind of stocks, growth stocks, that kind of stuff? And personally, in my opinion, yeah, I think there is, because with interest rate hikes, tapering, that's bad enough. If they actually do, and I actually still would be surprised they do this, actually go through with actually decreasing their balance sheet, that's a triple whammy right there for the market. And yeah, it's going to be a very volatile market. But the good thing is, I'm telling you, if this is anything like 2018, there's going to be some huge buying opportunities. I mean, huge, huge buying opportunities. The biggest thing we got to avoid, and I think this is what the Fed is on like a seesaw trying to avoid, which nobody's even trying to talk about it, which is going into a recession. Okay, that's a whole different video for a different time. But that's what they're trying to avoid, is going into a recession, because that is really not good for the market. But anyway, let me know your opinion. If you got anything out of this, hit the like, subscribe button. Let me know also if you like these condensed type videos. Like I said, I'll put a link down at the bottom for you of the whole 45-minute video of hers if you want to watch it all. Hope you have a good rest of your Sunday night, and I will see you tomorrow.